Hi, I'm Pattu from freefincal. Today let's talk about hybrid mutual funds and if they are really less risky than equity mutual funds. It's been 3 years since the SEBI mutual fund categorization rules came in. So now we can have a look at how the standard deviation or the volatility in the now changes from one category to the other. So we are first a quick definition. The conservative hybrid funds are those that can invest 10 to 25% in equity, rest in debt. Balanced hybrid funds are those that can invest in 40 to 60% equity without arbitrage and rest in debt. Aggressive hybrid funds 65 to 80% in equity. AMCs can either offer an aggressive hybrid fund or a balanced hybrid fund. I think most AMCs go for the aggressive hybrid fund. And dynamic asset allocation funds are balanced advantage funds. They don't have any kind of limits on the asset allocation. Multi-asset funds should hold at all times 10% of equity, 10% of gold and 10% of bonds. Then the rest is they're free to handle the rest the way they want. Arbitrage funds are now hybrid funds. They have to invest 65% in equity and 35% in bonds. Minimum 65% they have to invest in equity and equity related instruments. Some of this can be arbitrage. There's no limit on the arbitrage also. Equity savings are those which should have a minimum of 10% in debt and 65% in equity and equity related instruments. The amount of arbitrage and direct equity should be specified in the scheme document. So now what I have done is I have now plotted the standard deviation over the last 3 years for all these categories. The y-axis is the 3-year standard deviation. The x-axis is just the fund number, so I have not shown it. So let's start from the top right hand side here. This is the Nifty index funds, the blue dots here. Then you have the active large cap funds which have standard deviation above and below the index funds. Then you have multi-cap funds. The crosses are the crosses are multi-asset funds, multi-asset funds. And you can see that the category is very poorly defined because you have a wide range of standard deviations possible. This outlier large cap is JM large cap because it held a lot of debt during the crash, and even now it holds close to 20% debt. I think it fell the lowest, and its standard deviation is also low. And then coming to this side, all the way to the other side, you have aggressive hybrid funds. These triangles are aggressive hybrid funds. This is the reason you can notice that there's not much of a difference between the volatility of aggressive hybrid funds and equity funds. That is the reason why I keep saying don't split the equity debt asset allocation of aggressive hybrid funds. Treat aggressive hybrid funds as pure equity funds. And then you have these gray dots which are balanced advantage funds. And you can see there's a huge spread in the standard deviation of balanced advantage funds. The dynamic asset allocation funds are the plus signs here. They are bundled here, but there's some overlap between dynamic asset allocation and balanced advantage, but not too much. And you can see that the equity savings funds have a comparable standard deviation to that of the dynamic asset allocation and even balanced advantage funds, which is kind of very confusing. The conservative hybrid funds are the red dots that are reasonably bunched together here, just a bit less volatile than equity savings and dynamic asset allocation. Now, these are the arbitrage funds. There's one outlier arbitrage, which is, I think, if I'm not wrong, principal arbitrage. I think it's principal arbitrage. This had a credit event, that's why it's there. And this guy here, this is HDFC Prudence. HDFC Prudence is only a balanced advantage fund in name. Other than that, it's a very it's practically an equity fund. So if you actually look at this, aggressive hybrid fund, the risk is reasonably well defined. It's close to equity. Equity, obviously, you have a reference point that also is known. That's well above there. That's risk. Multi-asset funds, you must practically treat them as equity funds alone. For all practical purposes, they're equity funds only. Balanced advantage fund, they are a little less volatile than most of them are a little less volatile than aggressive hybrid, not too much. Conservative hybrid funds are a little less volatile than balanced advantage funds, little less volatile than equity savings and dynamic asset allocation. Between balanced advantage fund, dynamic asset allocation and equity savings, there's not much difference. Then you have arbitrage at the bottom end. Arbitrage is more like a debt fund volatility. It's like ultra short term fund and so on. Now my problem is these guys here in the middle, they are somewhere in the middle. They are neither equity nor debt, and that's always a problem for investors. That is why I feel that conservative hybrid fund, balanced advantage funds, equity savings, dynamic asset allocation fund, these are not suitable for all investors. They have to be very careful, because once you choose these categories, the investor does not want these funds to crash. When the equity market crashes, they expect their fund to not crash. When the equity market zooms up, they expect the funds to at least zoom up also. I mean, if not beat the market, at least give good returns. That's not always possible. It's a very difficult problem, and that is the reason why I keep saying avoid these kind of funds. It's not for everybody. If you have the right risk expectations, you can invest. I'm not saying you should not invest, but most people don't have the right risk expectations, and therefore it's better for them to either stay on one side, which is high risk, or on the other side low risk. If you go into the middle, then it is what I call as the Sita or Gita kind of funds. You expect the same fund manager to behave one time like Sita, one time like Gita. It's not going to happen. It's just not possible. That's why I wanted to make this post, that many hybrid funds are not actually less risky than equity, because the risk is unknown, undefined, or ill-defined, I should say. They are more risky than equity funds, in my opinion. Bye bye.